For more on the BSP's latest move and what it means for interest rates, markets, and the economy, we're joined by ATR Asset Management Group's Head of Macroeconomics and Sustainability Research, Jomar Lacson. Hi, Jomar. Thanks for being here with us this morning.
Hi, Mikey. Thank you.
Okay, so Jomar, the BSP decided to keep rates steady. How surprised were you by this move?
Well, the market was already anticipating a cut, and so were we. And it's because the communication ahead already been that the cut would be was sort of imminent. So it was a surprise for the market. But I think with the presentation, with the briefing, it was explained what has changed.
Right. It's the Trump risk premium. It's the external factors, and they just wanted to take a prudent stance. What does this tell you about the situation?
Well, it's understandable if you think about it, because the main issue here really is the change in the trade policy of the U.S. and it was mentioned in the briefing that if you think about it, tariffs have been coming down for the past 60 years. So most of the models we have with respect to inflation forecasts are based on that trend. So the change in the trade policy now begins at sort of a dynamic interchange, meaning the U.S. raises tariffs, will the other countries raise their tariffs, and what's the response? So now we have this sort of game. And what that means is that the models that we're using right now to predict prices or inflation may not be reliable.
Yeah, your job just got even more difficult.
Right.
But at the same time, we're still in an easing cycle. BSP Governor Eli Robelona said that a 50 basis point cut for the balance of the year is still on the table. It's just the timing that they need to figure out. And there are perhaps maybe 5 more meetings until the end of the year. All right. What do you think, what are the biggest risks locally?
Well, it's actually most of our risks, I think, is really external. And that's why we're also watching what's happening in the U.S. and, of course, how countries will respond in kind. And
so wait and see.
Yeah, but the effect there is really, the transmission is really through our exchange rate. So that's the most important part in how it sort of like affects our business costs. So one of the things that we're kind of I would say this, the things that have changed, and I think this kind of matters to the central bank, is our dollar reserves had peaked in October around $112 billion. I think the latest report is about 103. So that's like a $9 billion decline for the past 3 months. So
what does this tell you?
Well, it's a significant change. If you look at our economic history since the 1960s, whenever our reserves are kind of volatile, that actually spells a bit of a concern. That this is the uncertainty that we're talking about, and I think it's just prudent for the central bank to hold off on the rates, and because the reserves are very important to maintain our our credit ratings. So it is I think it's just by maintaining the rates, they are able to signal to the market that we are keeping everything stable at this point. And let's see where things evolve, because if things, if the trade war, we don't know. Again, we don't know how it will, and if it results in let's say a trade deficit expansion, which we already have, it expands further, then we'll need the strength of our dollar reserves.
Yeah.
So that's why I think it's important to be a bit defensive, a bit more prudent at this stage.
Going back to interest rates, we're still, the country is still expecting a cut of 50 basis points. How important is this reduction in interest rates to the economy now, given that we missed the growth target in 2024?
Yeah. So for us, it's very important because coming from the lockdowns, we've already mentioned this in the past about economic scarring. So those scars are, for that to heal, we need to start investing, for capacity expansion. If we don't do that, then that actually creates more strategic issues. That's why interest rates have to come down, allow companies to refinance and stop and and shift from financial management, meaning making sure their balance sheets are actually quite stable, to now expanding the balance
And
sheets.
catalysts for growth.
Yeah.
Yeah.
So we need to look at growth already but as long as interest rates are at these levels, will always be that in that cautious optimism phase. What we need to have is just take out the caution and put in the optimism.
Yeah, we just need the optimism. Speaking of optimism, with a strong catalyst, stocks can outperform. I mean, look at the shares of Jollibee yesterday. They jumped 11% after its foreign ownership limit was lifted. What does this tell you?
Well, it's really specific to Jollibee. You know, the markets themselves are still waiting on macro indicators. So just taking it specific to Jollibee, it begs the question: why would you want to remove your limit unless it's a constraint?
That's an interesting question. Was the limit even an issue? Was it necessary? Right? I mean, how close did they ever get to hitting that ceiling that the cap needed to be lifted?
Well, from our discussions, trying to recall, I think the maximum was around 30% for Jollibee. So unlike in the past, when you had the likes of
PLDT, and Ayala.
Yeah, wherein we had a discussion on voting preferred shares and everything like that. But the point is, those were the stocks that actually had issues with the foreign ownership, foreign ownership.
Maybe they're just preparing for better times ahead. And do you think other companies will follow suit?
Well, I think we've already lifted a lot of the restrictions. I mean, we just had the Public Service Act. I think so. We've already lifted foreign ownership limits for specific industries such as energy. So I think that's it. The regulatory component is already supportive of additional FDI coming here into the Philippines, and of course portfolio inflows.
And that's what's missing in our equation, FDI inflows. What's it going to take what's it going to take to bring the foreigners back into our market, Jomar? I
think it's still going to be growth. I mean, just going back to Jollibee, I mean, we'll have to wait until the fourth quarter earnings start coming in, and it will validate whether, during a period of in the fourth quarter, we had 6 typhoons in a month. So did that have an impact on growth? And clearly, the GDP number said yes.
Yeah, 5.6%, below the government's 6 to 6.5% target.
Right.
What's your take on where we're headed? What's your take on the Q4 earnings in 2024, and what's your take on where we're headed for 2025, given that it's an election year?
Yeah. So we think that the team, Atram Equities team, is very optimistic about the earnings outlook. Primarily because we believe that consumption will continue. I mean, remember, we are a very strong domestic-driven economy, right? And we think the outlook is for 11% earnings growth for the market. Now, the main sectors that I think the team thinks will be positive are the banks, primarily because of the interest rates. Banks that tend to benefit from high interest rates, and as we maintain interest rates at these levels, they should benefit more.
Borrowers, yes, they should benefit from that. Okay, because it's Valentine's Day, I want to ask you a Valentine's themed question, which is a little hard to ask given your area of expertise. But how about this? Valentine's Day is a major spending event in the Philippines. Over 70% celebrate, and nearly 90% buy gifts. So it's nice. I mean, after Christmas, it's a nice consumer spending event. Is this a true reflection of consumer confidence, the activity that we see on Valentine's Day, or is this just an emotionally resilient, activity?
We'll actually find out a bit. To my mind, it never gets reported in actually earnings for retail companies or for major factors. Of course, Christmas. You can see that drive sales strongly. So on Valentine's, not so much. But having said that, we know that malls are going to be full, and this drives mall revenues because some of the malls actually their leases are actually derived from sales. So we'll see probably some of the property companies that have strong, large exposures to retail benefit from that. Yeah, so on Valentine's, I guess, speaking of which, it's on the, in terms of what benefits, there are actually some business models that do benefit. I mean, you'll see in the sales, like, if you look at Warren Buffett, right, one of the key companies that he invests in is See's Candies, which are very expensive, right? Mm-hmm. But on Valentine's Day, that's when they really make, I guess,
all those resilient emotional expenses that drive companies like See's Candies.
Yeah, flowers, again, for example.
Yeah, flowers, food and beverage, all are gonna, get that gain on this day. Yeah. All right, so thank you so much, Jomar Lacson from Atram, for sharing your insights with us.
Thank you, Maggie.